The cash flow analysis shows the flow of money in and out. It can form part of both valuing the risk and potential in one's own company, as well as before investment decisions in other businesses are made. The following video goes through the cash flow analysis in 3 fundamental steps with a direct method. Step 1. Operating activities. The very basis of the daily activities and consist of the main revenue generating activities. Step 2. Investing activities. The accumulation or sales of fixed assets. Step 3. Financing activities. Consist of business transactions between the owners and potential lenders. First out of the operating activities is cash received from customers. This is a collective name for business net sales, with various adjustments for the cash flow. The category constitutes net sales, which include all income from goods sold and services rendered after the deduction of value-added tax, VAT, tax and any discounts. To the net sales, add the opening balance, OB, accounts receivable, and subtract the closing balance, CB, account receivable. A trade receivable is a seller's credit with a buyer, usually in the form of an invoice, for which the seller has not yet received payment. Add the opening balance, accrued income, and remove the closing balance, accrued income. An example of an accrued income might be for a mason who performed work in year 1, but was not paid until year 2. The mason completed the facade as agreed in December, but did not send the invoice until January of the following year. Thus, the payment was received in year 2, but the income belongs to the financial statements in year 1. Finally, subtract the opening balance for prepaid income and add the closing balance for prepaid income. For example, it can be a rental fee that has been paid in advance. The rent is paid in December of year 1 for January in year 2. This means that the payment was received in year 1, where the income must be booked to the accounts in year 2. Thus, the first item, cash received from customers, in the operative cash flow is adjusted. The second part of the operating activities is payments to suppliers and employees. This is also a collective name, but instead includes the business cost of goods sold, with various adjustments for the cash flow. In the category payments to suppliers and employees, first subtract the cost of goods sold. This includes, among other things, cost directly related to manufacturing or the provision of services. Next, subtract all costs related to personnel, for example wages, salaries and social security cost. Moreover, subtract the other operating costs, such as the rental cost in a business or office complex. Add the opening balance inventory and reduce the closing balance inventory. Inventory can be anything from raw materials to goods and products. Subtract the opening balance accounts payable and add the closing balance accounts payable. It represents the money owed to the creditors. Adjust for changes in provisions, which can be both positive and negative. The term provisions mean obligations that are likely, alternatively certain to occur, but uncertain as to when or to what amount. Furthermore, subtract the opening balance accrued cost and add the closing balance accrued cost. An example of an accrued cost might be for a construction company that ordered and had cement delivered in year 1, but did not pay for the service until year 2. Cash decreased in January of year 2, but the cost was incurred in December of year 1 when the service was performed and must be recorded in that year's financial statement. Finally, add the opening balance of prepaid expenses and remove the closing balance, prepaid expenses. A prepaid expense can be, for example, when a business pays a consultant at the end of year 1 for a project that will be carried out at the beginning of year 2. Payment takes place in year 1, but must be booked as an expense to the account in year 2, when the project is carried out. This compiles the second part, payments to suppliers and employees, for the adjusted cash flow in the operating activities. The inflow of money from part 1 minus the outflow of money from part 2 adds up to the cash flow from operating activities before interest and tax. The third part of the operating activities is interest received. In the category interest received, first add the business interest income. This is income that arises, for example, within a bank account or for lending capital to another business. Add accrued interest income at the beginning of the period, opening balance, and subtract the interest income at the end of the period. Accrued interest is interest gain from outstanding debt. It has been accumulated but not yet paid for. Left is interest received. The next and fourth part is interest paid. Subtract the business interest expenses. This can be, for example, interest for a delayed utilized credit period with suppliers or a late payment interest. Additionally, remove the accrued interest cost at the beginning of the period and add the accrued interest cost at the end of the period. Accrued interest costs are booked as interim liabilities and are interest costs incurred but not yet paid for. Left is interest paid. The fifth and final part for calculating the cash flow within operating activities is income tax paid. In the category of income tax paid, start by subtracting the input tax liability and then add the output tax liability. Add or subtract the current tax taken from the income statement, the tax that the business must pay on the current year's potential profit. Eventually, add the input tax receivable and subtract the output tax receivable. The tax receivable are debited tax that has been paid during the months of the financial year. With the last part completed, the cash flow from the operating activities can be summed up. Based on step 1, step 2 follows, which concerns the investment activities. All potential acquisitions and sales of fixed assets are examined here. The process for calculating and checking whether the business has acquired any fixed assets is the same for all 3 items, for acquisition of intangible, tangible, and financial fixed assets. The acquisition of fixed assets is examined by adding the opening balance of the asset to be investigated. That is, by choosing one of the 3 different assets, either intangible, tangible, or financial fixed assets, and adding the entering balance. The next step is to subtract all depreciation for each asset, meaning the systematic reduction of assets' value over time. After that, remove any potential write-downs. It happens when assets, their acquisition costs, are revalued with a negative amount. Add potential appreciations or increases in assets value by revaluation, if such a revaluation has been made. Subtract the book value of assets that have been sold. Finally, subtract the closing balance for each fixed asset. What remains is the sum of the year's investment for each asset. The third and last part of the cash flow analysis represent the disposition of fixed assets. It is a similar process as the one before when investigating whether any acquisition of fixed assets have been made within the investment activities. Within the category of disposition of fixed assets, the calculation and control of whether any sales of intangible, tangible, and financial fixed assets have been made during the period are examined here. The disposition of fixed assets is examined by comparing the book value of sold assets against a potential capital gain or a capital loss. For example, if an asset had a book value of 2 and a capital gain of 1 was made, the sum of 3 should be added to the sales regarding cash flow of that item. Likewise, If, for example, an asset had a book value of 4, and instead a capital loss was made of 1, the sum of 3 shall be added to that asset item in the cash flow. When these 6 parts are checked, they can be summed up and together show the total cash flow from investment activities. After step 2 is done, finally, step 3, the financing activities, and the last step are calculated. The part accounts for how money comes into the business or disappears from it, based on, among other things, changes in indebtedness. The first part to investigate is whether the business has made any new right issues. So, if the company has brought in some new money by offering, for example, the public or existing shareholders the right to subscribe for new shares. This is done by adding the contribution of share capital. The capital is calculated by comparing the quota or par value, which is share capital, to the number of shares and multiplying the number of new shares that the business issues or gives out. Since the payment for a share might not be lower than the previous par value, but may exceed it, the potential higher payment constitutes a premium or an additional paid-in capital. This sum is not included in the share capital of the new issue, but is instead moved to premium fund. The share capital of the new issue plus the premium fund together form the additional equity capital. The second part of the cash flow from financing activities is change in notes payable. In the category change in notes payable, start by subtracting the opening balance of the loans. The loans can be long-term, which means that the debt is due for payment after more than 1 year, while the short-term loans are due for payment within 1 year. Then add the closing balance for long and short-term liabilities or loans. The closing balance for loans, together with the opening balance loans, constitutes a net change in loans. Finally, add amortization, which is the repayment of the loans, to the sum of the loans' net change. The remaining value shows if the business has taken out any new loans for the period. The third part of the financing activities is the amortization of loans. The category amortization of loans does not even need any calculation. It can be read directly from the balance sheet. Amortization of loans is equal to the opening balance of short-term loans. The fourth and last part of cash flow within financing activities is dividends paid. The category of dividends paid investigates the outflow of capital or return to the business owners. Capital that can be used for dividends mainly consists of balance result, the sum between profits and losses from previous years, with deductions from previously made dividends. It can also consist of the year's profit, or that, for example, when shares in subsidiaries are distributed instead. The capital is distributed to the owners and become a form of reward or return to the owner's invested capital in the business. Taken together, these 4 parts show the total cash flow from financing activities. Thus, all steps are calculated and checked for in the cash flow analysis. What remains is to sum up these 3 steps. The period's cash flow then becomes the sum of the positive or negative change in step 1, operating activities, step 2, investing activities, and finally, step 3, financing activities. Finally, the incoming cash, which is found in the balance sheet, can be added to the period's cash flow and together form the outgoing cash for the period, or in other words, liquid assets at the end of the year. For more videos, please subscribe. If you like this video, make sure to check out the next one. Thank you.